Okay, folks, get settled in. So the usual rules apply. When the quizzes are done, I will let you know that they're done. You can come pick them up, face down. You know the drill by now. I won't talk about the quiz, but I'll tell you in every problem there was one little tweak. That's it. Right? Every problem was mostly familiar, but there's one little tweak. And I don't want to talk about the tweaks because if you did not get it, you're going to get really pissed off right now, and that's nothing's gained by that. Okay? But I thought it was a straightforward quiz, but I always do because I write the quiz. So you'll find out soon enough. So what I want to talk about today is I actually want to continue our discussion of dividends. And when I started this section, I said, when you look at dividend policy, there are two questions you're answering. One is, how much should my company return to its stockholders in cash? And the other question you're answering indirectly is, how much cash is too much cash? So we all know the Apple story, right? Apple has a lot of cash, 170 billion in cash. Yesterday I was valuing Microsoft. You know how much cash Microsoft has? It's about $90 billion right now, 90 billion in cash. Google is 75 billion. We're talking about companies accumulating or having huge cash balances. And when you look at a company like this, the first question asked is, how did you end up with this much cash? And the answer is actually surprisingly simple. And to see what drives big cash balances, I'm going to take you back in time when Microsoft was the big dog in town, 1996. And I'm going to estimate free cash flow equity. Remember we talked about this last session? This is what you can afford to pay out. And I'm going to use the shortcut to compute the free cash flow equity. I took net income at Microsoft in 96, subtract out net capex, and it's tiny. In fact, let me pause there. This is a growth company. 96, Microsoft is a growth company. If you trust the accountants, they're saying Microsoft is reinvesting almost nothing, right? Net capex is 14 million. How do you reconcile the fact? How can you have a growth company that's reinvesting so little, at least in accounting terms? Yes? The biggest capex for Microsoft is R&D, and that's already being netted out to get to net. So that's why net capex is such a small number. Their working capital change was also a tiny number. Microsoft doesn't carry a lot of inventory. They don't sell stuff on credit. So you take a big net income, you subtract out a tiny net capex and a tiny change in working capital. Guess what? You got a free cash flow equity of 2,127 million. Remind me again what that tells me? That's how much Microsoft could have paid in dividends in 1996. In 1996, Microsoft paid no dividends and bought back no stock. So I have a very simple mechanical question. If you have 2,127 million in free cash flow equity and you return no cash back to your investors, where would I find that 2,127 million on Microsoft's balance sheet? Tell me where it can be. I'm glad nobody said retained earnings. Wrong side of the balance sheet. It might show it indirectly there. It has to show up in cash, right? Think of why. Why can't it show up in new projects? Because I've already subtracted out net capex and R&D, right? It can't be in working capital because I've taken out the inventory, the accounts receivable effect. The only place left for it to go is into the cash balance. Microsoft's cash balance in 96 increased by about 2.1 billion. 97, you replay the game. Microsoft now has a free cash flow equity of 3 billion, pays out no dividends, buys back no stock. So what happens? That 3 billion adds on top of the 2.1 billion. 1998, they had a $5 billion free cash flow equity. You know why it jumped? Just take a look at all the Windows upgrade years. Every time Microsoft does a Windows upgrade, it adds about $1.5 billion to its free cash flow equity. 5 billion, pays no dividends, buys back no stock. Think of what's happening here. The cash, this is accumulating, right? Cash balances each year. You had 2 plus 3 plus 5 plus 7 plus 8 plus 10. By the time you got to 2002, Microsoft at that point in time had the largest cash balance in corporate history, about 60 billion. Sounds small relative to the Apples of the world today, but in 2001, they had a $60 billion cash balance. And if I asked you how did that happen, you could have gone back in time and added up the free cash flows equity net of dividends each year, and you can actually do that for any company with a big cash balance. It's easy to explain how they get there. But here's the puzzle. In 2001, Microsoft had a $60 billion cash balance. That's a big cash balance, right? There wasn't a peep from investors, nothing from analysts, about it being too much cash. In other words, nobody was complaining that Microsoft had too much cash in 2001. How come? You're investors in Microsoft in 2001. When did Microsoft go public? Does anybody remember? It's 1986. Has it been a good 15 years for you? It's been an incredible 15 years. The company's gone from being a small application software company that did MS-DOS to this gigantic software company. What do you have to complain about? Remember I said dividend policy is all about trust? And in 2001, Microsoft had earned enough trust from its stockholders that they said, we're okay with you having 60 billion. We'll talk about what changed by 2003 and 2004 because the same company came under pressure. But you can see how companies can end up with big cash balances and not get assaulted by investors if investors trust them. So that's why I think it's useful to compute a free cash flow equity. You will get a sense not only of how much your company can pay out this year, but you can also get a measure of why your company has the cash balance that it has right now. So to compute free cash flow equity, for a traditional company, we start with net income. We add back depreciation, we subtract out capex, change in working capital, the debt payments, we bring in debt, new debt issues, pay off. But if you think about that process, it's almost impossible to use that process to compute the free cash flow equity for a bank. Think of why. I'm not sure what depreciation is for a bank. Capex, change in working capital, debt payments, every single item on there is going to be like nailing jello to a wall. It's almost impossible to nail down. So I'm going to give you an alternative. If you're looking at a bank or an insurance company, none of you are doing that on your project, but you could have, this might be a sector. So here's what I'm going to do. Rather than define reinvestment, and I did this earlier too when we talked about capital structure, rather than define reinvestment as investment in land, building, equipment, machinery, capex, R&D, for a bank I'm going to define reinvestment as investment in regulatory capital. Know what I mean by regulatory capital, right? There are regulatory capital requirements banks have to meet in order to be able to survive and grow. So if you want to grow as a bank, you have to meet those capital requirements. And if you don't meet them, then obviously either make up the difference or they shut you down. So to me, that is the equivalent of capex in a bank. Is to grow and to survive, you've got to maintain those regulatory capital requirements. And it's not just meeting the minimum. You might be a conservative bank and have a target that's much higher, in which case you've got to come up with more regulatory capital. So here's what I'm going to do. I'm going to start with the net income for a bank. JP Morgan, Bankers Trust, any other bank, okay? Deutsche Bank. In this case, I took Deutsche Bank and I took their net income and I subtracted from the net income the amount that I thought they would have to invest in regulatory capital. And let me give you a sense of how I came up with that number. I knew what Deutsche's existing regulatory capital ratio was. They also had telegraphed what their target. So basically they said, you know, we're at 15.13%, we need to get to 18%. We're undercapitalized. In fact, that's a message that they've been sending out pretty strongly. So already you know that you're in the hole, right? To get from 15.13 to 18% means you've got to invest more in regulatory capital. And here's an added layer of reinvestment. They're growing about 4% a year. Why does that matter? Because if your risk-adjusted assets are growing, you're a growing bank, you have to invest even more in regulatory capital. So this investment in regulatory capital captures how much Deutsche has to bring in each year. So let's take year one. They have net income of 602 million. They need to come up with 4.6 billion euros in regulatory capital. How much can Deutsche afford to pay in dividends next year? Well, they're already in the hole. They shouldn't pay dividends. In fact, if you look at the projections, based on free cash flow to equity, they should not be even thinking about paying dividends till year 4 and perhaps year 5, because that's the time that they see daylight in terms of cash flows. But here's the problem. Banks get into these policies of we will maintain dividends at any cost. They have negative cash flows like Citi did for a few years, and they continue to pay dividends. In the US, you have one constraint if you're a bank. If you're one of the top banks, the banks that got help in 2008, before you pay a dividend or buy back stock, you know what you have to do today? You have to get the Fed's approval for whether you can pay dividends or not. You know what the Fed looks at? Its own variant of free cash flow to equity saying, hey, you guys can't pay a dividend, you can't buy back stock. Citi, in fact, was stopped from buying back stock last year because the Fed said, you're already undercapitalized, we're not going to let you buy back stock and make yourself even more undercapitalized. But if you're a healthy bank, this has to come from you. You have to estimate what you can pay in dividends and make sure you're not paying more. So the free cash flow to equity is a measure of potential dividends. You can compute it for non-financial service companies and financial service companies using different techniques. So let me show you a graph which I think captures why this statistic is so critical. In many traditional corporate finance books, the assumption is companies pay out what they can afford to in dividends. Implicitly, what do they say? Well, free cash flow to equity gets paid out in dividends, but that doesn't seem to be the case. At the start of every year, I actually do this comparison of what companies pay in dividends to what their free cash flow to equity is. It's a very simplistic comparison. I take the last 12 months leading into 2015. I compute the free cash flow to equity that year and dividends that year. It's very limited, but I'm going to go through group by group, and you tell me whether this group looks like it's doing the right thing. So the first group, so the left purple group, are companies with negative free cash flows to equity, and they pay no dividends. Make sense? Yeah, so that first group you can live with. The second group, which is this green group, is free cash flows to equity which are negative, and they pay dividends. And you'll have some questions for them, right? Maybe they'll tell you, look, last year was just a bad year, we're going to come back to it. But these are companies that at least in the 12 months leading into January 2015 look like they're paying a dividend, but they don't have the cash. They have a negative free cash flow to equity. The third group are companies with free cash flow to equity greater than 0, so it's a purple, but pay out more than their free cash flow to equity in dividends. So you have 100 in free cash flow to equity. These are the companies that pay out 250. Again, very same question you asked the previous group saying, can you explain why you're paying so much in dividends? Maybe again they can bounce back and everything's going to be okay, but they're in a deficit. Then you have the fourth group, companies with free cash flows to equity that are positive, that pay no dividends. So what's happening in these companies? You have the Microsoft effect, right? The cash balance is building up. Again, it doesn't mean you're going to insist that the cash be returned. You might be okay with these companies accumulating cash because you might feel that you can trust them with your cash, but these are some of the companies where you're going to see big cash balances. And in the last group, you have companies which have free cash flows to equity greater than 0. They pay a dividend, but the dividend is a lot smaller. And when I say dividends, include stock buybacks as well, because I'm adding the two, than the free cash flow to equity. That's the case with Apple. They have huge dividends. In fact, they announced a hike in dividends 2 days ago with their earnings report. They do a lot of buybacks, but in spite of doing all of that, their cash balance keeps going up. So last year, I think they returned, what, $40 billion to the stockholders. Their cash balance went up by another $10 billion. So if you return less than your free cash flow to equity, your cash balance will keep increasing. So with that in mind, let's talk about what happens to a company which accumulates a large cash balance but doesn't get the Microsoft treatment. The Microsoft treatment in 2001 was, it's okay. Or the Google treatment today, it's okay, 80 billion, no problems. So the company I'm going to use is actually Chrysler, and it's from 20 years ago. For those of you who know the history of Chrysler, Chrysler had a near-death experience in the early 1980s. It was the original federal bailout, right? 1981, Chrysler almost went bankrupt. It didn't get the same kind of help that GM did, but it got some help from the federal government. It was able to survive, but it barely hung in there till the mid-80s when it got a new CEO, a guy called Lee Iacocca came in as the CEO. And he created a monstrosity that I curse every time I pull into a CVS parking lot. Know what he created that saved Chrysler? The minivan. The original Dodge Caravan. So the next time you see a minivan, curse Lee Iacocca. He saved the company, but at what cost? Okay? At least it's not a Suburban, right? I mean, those really freak me out. The guy pulls into the next parking lot, he's like taking three parking spots. But he did essentially put Chrysler back on financial health. What you have here is essentially my computation of free cash flow, equity, and dividends each year from 85, which is when Lee Iacocca joined. He left in the late 80s, but I'm going to keep going. So each year what I'm doing is I'm calculating the free cash flow, equity, and dividends, and I'm taking the difference and adding it on to the cash balance from the previous year. Entering 1985, Chrysler had almost no cash. So in 1985, they had $1.5 billion in free cash flow equity. They paid out about $200 million in dividends. So in 85, their cash balance increases to $1.2 billion. So is everybody clear on what I'm doing? Each year, I compute the free cash flow equity and dividends. I take the difference. I add it onto the cash balance each year. By the time you get to 1994, Chrysler had a cash balance of about $8.5 billion. Doesn't sound like much, especially in today's market. We have 60, 80, 170 billion. But by 1994, Chrysler was about, the entire market value for Chrysler as a company was about 30 billion. So by 1994, Chrysler was 30% cash, 70% automobile company. And unlike Microsoft, it was targeted by investors. In fact, it was targeted by one very specific investor, a guy called, does anybody know? Kirk Kerkorian. Basically, I think he was, he's still around. But he was like in his late 80s by then. I think he's now 110 or something. They might stuff him and move him around. No. But in 94, Kirk Kerkorian targeted Chrysler saying, you guys have too much cash. You know what Chrysler said immediately, right? No, we don't. And their first defense, what was the first defense they offered for why they needed so much cash? It's a pretty obvious one. We're a cyclical company, and we're one recession away from going under. Therefore, we need the cash. Sounds reasonable, right? So let's test out that proposition. That's a fair statement that you need cash. But the question is, do you need $8.5 billion in cash? Is there a recession sometime in this 10-year period? 91 recession. That's actually what caused George Herbert Walker Bush's presidency, right? That recession in 91, 92. Pretty bad recession for the automobile business. Did Chrysler burn through some cash? Yes. In fact, over that 2-year period, its cash balance decreased from $3 billion down to about $2.5 billion. So it burned through $500 million in cash during the last recession. Let's do a little algebra problem. If the last recession lasted 2 years and you needed $500 million to get through it, how long will the next recession have to last for you to need $8.5 billion? I think it's like 34 years maybe. It's 2 times 17. I think 2 is 500, 17 times this. So basically you're running a company in case there's a 34-year recession. That's like a guy who goes out in his backyard and starts building an ark every time it rains, says, this is the big one, I'm getting ready. I know you've got to be a prudent manager, but you can't act as if catastrophe is around every corner and be in a defensive crouch. This argument didn't work for Chrysler. They lost the argument. You know what their second argument was? It's not the recession we're worried about. We may need the cash to do a big acquisition. Does it make you feel a lot better as Chrysler stockholders? Given the history of acquisitions, this is like money going out through the door right now. So that argument didn't work either. In fact, Kerkorian won that argument eventually, and Chrysler returned about half of its cash balance. It was then taken over by Daimler, perhaps the most ill-fated merger of all time. Who thought that was a good idea? to have a straight-laced German company take over a Detroit automobile company, I don't know, but that merger was destined to fail, and it failed. Then Chrysler was taken back as a company by private equity investors. So it's gone through this entire process. But the process started in '94 because Chrysler was targeted because it had too much cash. In fact, GM, the buyback that I posted on the weekly challenge, and which I know you haven't looked at, the $5 billion was triggered because activist investors said GM has too much cash. Now this sounds like discrimination, right? You're letting technology firms get away with things and you're piling on automobile companies. Why do you think investors are a lot more nervous about automobile companies accumulating cash than technology companies accumulating cash? What kind of business is the automobile business? It's a horrible business. You accumulate cash, it's almost a guarantee that you'll find a way to waste the cash. I'm not being impatient or greedy. I just don't trust you with my cash. I want the cash back. So the next time you see a company targeted because it has a big cash balance, the CEOs will cry and wring their hands saying how terrible this is, how unfair this is that they've been targeted, how greedy investors are. Take a look at that company's history and you'll see why the company's been targeted. And if the company has a good history, it has a much better shot of fighting off that activist investor. Because then it can go to its stockholder and say, trust us, what have we ever done that would lead you to distrust us? So when you see big cash balances, think of how the company got there and then ask a follow-up question. Do I trust the managers in this company with my cash? So as I said, almost every item you need for the free cash flow equity is right there in the statement of cash flows. So pull up the statement of cash flows, go to Bloomberg, Capital IQ, 10K annual report, I don't care where you put it from, and go item by item, net income, depreciation, capex. So what you're computing is the free cash flow equity from the statement of cash flows, and you're also computing what the company returned to its stockholders, which all should be on the statement of cash flows, because what you pay as dividends and what you buy back as shares should be there. Compare the two numbers. See which of those 5 groups your company falls into. The 5 groups we talked about, free cash flow equity versus dividends, see where you put the company. Because here's the follow-up. Once you've compared dividends to free cash flow equity, actually collectively, cash returned to free cash flow equity, one of 3 things is going to be true. Your company might be one of those unusual companies that returns exactly what it should as free cash flow equity. I'll give you an example. When you compute this for Con Ed consistently returns about 95 to 100% of its free cash flow equity. The regulated utility. But that's unusual. When you look at your company, what's more common, more likely, is that it's either a company that pays out too little in dividends or a company that pays out too much. So this is about your company. Let's follow through. If your company pays out too little in dividends, it's building up a cash balance, right? And it's your cash, you as a stockholder. Ask yourself, do I trust the managers in this company with your cash? You don't have to answer to anybody else. It's your money. If you don't trust managers, you have every right to demand it back. And think of what you base that trust on. You look at history. What kind of returns has my company had on its projects? What kind of returns has it delivered on my stock? The Jensen's alpha and the return on capital versus cost of capital. And if the company has a history of picking good projects and delivering good stock returns, I think it has a pretty good shot holding on to the cash. You earn the right to accumulate cash. You're not endowed with that right. You have to earn the right. You earn the right by delivering on your projects and on the stock. If you have a history of destroying value, you have a history of seeing your stock price collapse, then don't expect investors to trust you with the cash. They're going to fight you for the cash, and you know what? Let them win. Give the cash back, and if you want to accumulate cash, what do you have to do? String together 5 good years, and you'll be amazed at how much more power you have to accumulate cash. So if you're accumulating cash, the onus should be on you as managers to explain to me why I should trust you with the cash. The onus shouldn't be on me to explain to you why I deserve my own cash back. It is my cash. Now if you have too much in dividends, for whatever reason you're in this problem of paying too much in dividends, then you're running down cash balances. Worse, what are you doing to make up for that deficit? You're either borrowing money or raising equity on the other window or cutting back on projects. You're doing all kinds of bad things because you've been locked into this dysfunctional dividend policy. Ask yourself whether you have good projects. You say, why should I care? If you have good projects and you pay too much in dividends, you do double damage to yourself. One is you dig a cash hole for yourself. The second is you would reject investments you otherwise would have been able to take because you don't have the cash to take them. You've created a capital rationing constraint out of nowhere. And if you really have good projects and you're paying out too much in dividends, you've got to reduce the cash paid back. I'm not saying it's easy to do, but you've got to come back. If you have bad projects and you're paying too much in dividends, I don't even know where to start with you. Because if I let you cut dividends, what am I afraid you might do? Take more bad projects. Remember, your problem here is not a dividend problem, it's an investment problem. Do you see what I mean by an investment problem? Why are you unable to pay dividends? Because your earnings are low. Why are your earnings low? Because you took bad projects. If you don't fix the problem, which is taking bad projects, you fix the symptom, which is dividends, the problem will come back. So it's a very simple framework, and I think of it in a matrix. On one axis, I look at how much cash the company returns to its stockholders relative to its free cash flow equity. On the other axis, I look at the quality of the projects. So if you have 5 companies in your group, think of it in the matrix and see if you can put it in the matrix. You're saying, how do I define good projects? You have to earn more than your cost of capital. That's a good project. Less than your cost of capital is a bad project. If you pay out more than your free cash flow equity, you're returning too much. If you pay out less, you're returning too little. If you're a company with poor projects and you accumulate cash, expect to see pressure build up on you. If you're a company with good projects and you accumulate cash, you get a lot more leeway to do what you want with the cash. If you're returning too much in cash and you have bad projects, you've got to start by fixing your investment problem first. And then you can deal with the dividend problem or deal with it simultaneously, but you can't just cut dividends and let the investment problem fester. And finally, if you're paying out too much in dividends and you have good projects, you're doing double damage to yourself. Cut back on the cash return. If it's buybacks, it's easy. If it's dividends, it's a little messier, right? Why? They're sticky, right? And remember what happens when you cut dividends? Initially, people are going to freak out thinking you're in deep trouble, but you have to take your medicine and move on, because the longer you put it off, the worse it's going to be. So here's what I'm going to do. I'm going to take a series of companies, and I'm going to essentially play the role of the CEO of the company. And you're going to be stockholders in each of these companies, and I'm going to ask you a very simple question. Do you trust me with your cash? And I'll give you the data to make that judgment. But let's start with Microsoft. I told you that in early 2001 or 2002, Microsoft had accumulated this big cash balance, and nobody seemed to raise a fuss about that cash balance being as big it was. There was no demand for dividends and buybacks. Everybody was okay. Just a couple of years later, stockholders started demanding their cash back. So what happened in 2001 and 2003? One is, I think, the Justice Department had that antitrust case against Microsoft to talk about breaking it up into 2 companies. The other is, Microsoft has had only Zune and other stuff, but Microsoft has had only 2 hits in its history, right? Windows and Office. Take a look at their existing 10K. Look at how much money they make on Windows and Office and how they lose on everything else they do. That gave them that rise from 86 through 2001, but Windows and Office came out in the early 90s, so the longer people started waiting for the next big hit, and the next big hit did not come, the more likely it was that people were saying, hey, you know what? I don't think it's coming. Trust is not everlasting, and in this case you could see it dissipate. And I'll give Microsoft credit. I don't like the company. I don't like what it does. I hate its products, but I use them anyway because it's a PowerPoint presentation. Right? But here's one thing that Microsoft has done that I think other companies can copy. They've always been responsive to stockholder. They don't go listen to analysts saying don't do this. They listen to investors, because in 2003, when the pressure built up from below for cash to be returned, I talked a little bit about this. What did they do in the last quarter of 2003, right after the tax law changed? They paid the biggest dividend in corporate history, $33 million. They didn't sit there and debate. They didn't fight the stockholders saying you shouldn't be asking for the cash back. They said, you know what? You don't trust us, here's the cash. And that, I think, is the right response from companies, is when people don't trust you with the cash, fighting them is not going to make the problem go away. It's only going to make it worse. Give the cash back and earn the trust again. fact, yesterday the reason I was valuing Microsoft is I just put this up in my blog. We know what CEOs get paid, right? Woodman, who's CEO of GoPro, I think got a $284 million pay package. The CEO of Target got $28 million. Satya Nadella at Microsoft got $84 million last year. So we know this is set by a market, a CEO market. There's a pricing of CEOs. So the question I was asking was, we know what the price of a CEO is. It's big. But what's the test we ask about any investment we make? We know the price we pay, but unless the value we get is greater than that price, I don't know who the CEO is. So what I did in the blog was actually create a spreadsheet for valuing a CEO. You can actually change it to make it about you. So you join JP Morgan, you can value how much, and then you can go negotiate. Say, I've worked out that I add 50 million to JP Morgan's bottom line. I would like at least 75%. Settle for 50%. Give me 25 million. Now, that's how traders actually negotiate, because they can see what goes right into the bottom line, so they can go and say, hey, we brought in 80 million. But this is actually a spreadsheet. We can play with the numbers there. I increase growth at JP Morgan. I reduce risk at JP Morgan. All kinds of neat stuff. The bigger your ego, the more value there will be to whichever company you join. But basically, the reason I bring that up is I actually bought Microsoft shares. Don't let this get out of this room. This is the Darth Vader of technology, and I bought shares in them in 2013 because I said, partly because I felt sorry for them. Okay, so they were no longer the evil empire, because who can be afraid of somebody who hasn't produced a new product for 25 years, right? So I bought shares in 2013, and they've done very well since Satya Nadella became CEO. So I said, you know what? As a stockholder in Microsoft, I'm okay with 84 million. It's not the magnitude of what a CEO gets, it's whether the value added. He hasn't shown me that he can find a new product yet. But I think he's in a better path already than Steve Ballmer was in terms of trying. Okay? So that's the essence. Do you trust the managers of the company with the cash? So let's start. So here's what I'm going to do. I'm going to be Disney CEO. And I'm going to do this in 2003. Who was Disney CEO in 2003? It's Michael Eisner. So already your image is set, right? I've been treating you like dirt for the last decade. Keep that in mind, because your history comes with you as a CEO. So it's 2003. This is the stockholder meeting at Disney. And I tell you, but in the last 10 years, my free cash flow at equity was $969 million a year. And I returned $639 million in dividends. So what have I already told you? Each year that I'm holding back about $330 million in cash. That's building up over 10 years into a cash balance of about $4 billion. So I have $4 billion of your cash. I'm Michael Eisner, you're Disney stockholders. And then somebody, not me, adds some additional statistics to help you make a decision. They say between 1994 and 2003, Disney's return on equity was about 2% less than its cost of equity. File that away. Right? Disney's stock price has delivered 3% less than the cost of equity. So basically my Jensen's alpha is negative, my excess returns are negative. So then I ask you, trust me with your cash. Now what do you think? If I put this up to a vote and it was a truly democratic vote, do you think you'd trust me with your cash? I mean, given this history, why would you trust me? In fact, if you add to that the fact that this is Michael Eisner asking you to trust him. And when things were going well, I treated you like you didn't matter, right? I mean, this is actually the reason CEOs should be good to their stockholders in the good times. Because there will be bad times and people will remember. So if you're arrogant up there because your stock is doing really well, there will be a point in time when your stock is not doing well, and these are the same stockholders you're going to get in front of. So in 2003, I wouldn't have been surprised if you said, no, I don't trust you with the cash. I want my cash back. It's not that you're greedy. You're being prudent, right? Now let me fast forward. So in 2003, if you looked at the dividend policy of Disney, you'd have said, you know what? I don't trust you with the cash. And on top of that, what got Disney into trouble was its big acquisition in 1996 of Cap Cities, ABC. And who pushed for that acquisition? It was me. So my track record works against me because of what I push for. And if I push for a big acquisition, I'm really loading up the dice. And that's the other thing CEOs have to remember, is if you do a big acquisition, you better pull it off. Because if you don't pull it off, you've lost the trust of your stockholders for the rest of your life as a CEO. So let's look at Disney in 2009. We're at the annual meeting in 2009. Disney CEO gets up. Who's the CEO now? It's Bob Iger, right? The anti-Eisner. I've created a smaller board. I look like I'm listening to my stockholders, right? And I've changed the policy. I've actually, over the last 5 years, returned more cash to my stockholders than my free cash flow equity. So rather than accumulating cash, I've been paying out cash. Okay? So in 2009, I get up in front of you and say, you know what? I have big plans for Disney. I want to build a new theme park in Beijing. I want to expand ESPN. I need the cash to do those investments. Would you be okay with me buying back less stock? And I put it to a vote. Again, no guarantees. But I'm on much stronger ground now because not only do I return more cash back, but if you look at what my stock price has done between 2004 and 2008, it's gone back to delivering more than it needed to. The Jensen's alpha is positive. My projects are delivering more than the cost of capital. Again, your strength, the strength of your case is going to depend on your history. And in this case, I have a much better shot of you agreeing to me holding your cash. Let's do one final round. 2013. So we return to the policies. So now Iger is now holding on to cash. Disney continues to make more than its cost of capital. Okay. This is before Frozen. Frozen would have made my case even stronger, right? So you come in after Frozen, everybody says, make as many movies as you want. Right? Right. But you can see that in 2013, you might still be okay with me holding your cash because the results are good, but you're watching, right? You're watching to see whether I keep this going. Nothing is, again, permanent. 2003, 2009, 2013, things change. In fact, Apple, classic example, as long as Steve Jobs was CEO. I never heard anybody say you should pay. Maybe because you wouldn't dare ask Steve Jobs for more cash back, right? But when Tim Cook became CEO, even before he got a chance to get his feet on the ground, people started saying, we want our cash back. So what changed? I mean, your projects are still good. The fear was that now that Steve Jobs was gone, that the new products would dry up and that Apple would be wasting money. So I think one thing that Tim Cook has really done well is he didn't do anything. You could have become impatient in 2011 and said, okay, I'll do an acquisition to show you. That would have been the worst possible thing to do. He kind of took his time and he's set his own path. It's a very different path from Steve Jobs, but you can see that that clamor for the cash return has leveled off. Even I said, no, please give me some cash rather than give me the cash now. So things are starting to change, but you can see how CEOs can take a while to get to that point where you trust them with your cash. So that's the first example. Let's take the second one. Now I'm the CEO of Vale, and your stockholders in Vale. I'm going to show you what the dividends and the free cash flows to equity look like for Vale, and I'm going to let you decide what I should do next. So if you look at the free cash flow to equity for Vale, in the aggregate over the last 5 years, it's 19.138 billion. So they could have returned almost $19 billion in cash. They actually returned $43 billion in cash. Houston, we have a problem, right? Returning way too much cash. So it seems obvious. I should be cutting back my buybacks and my dividends. But what's the catch? Why am I in this hole? Remember I had two classes of shares? Common shares and preferred shares. Every Brazilian company has, and Vale has them in spades. You all have the preferred shares, which gave you no voting rights, right? But in return for no voting rights, what did I do? I promised you a fixed dividend. And if I don't pay that dividend, guess what happens? You get voting rights. I am trapped. As long as I want control, and I basically is the Brazilian government here. It's not even you as a CEO. Guess what? I have to keep paying dividends. You know Petrobras still pays dividends? What the heck are they doing? It's a basket case company. I'm not talking about corruption dividends, actual dividends to stockholders. Right? They have to pay dividends because they have two classes of shares. And those two classes of shares bind them into a dividend policy. So when I get up there and say, look, I'd like to cut dividends, iron ore prices are down. I have a good economic case, but if you're stockholders, you shouldn't be stupid and say, okay, cut dividends. You should, in return for cutting dividends, demand what? Demand voting rights. It's amazing how companies value control so much that they're willing to go bankrupt with full control, then give up control and be a healthy company. So Vale, you can see the source of the problem goes back to that session 2 when we talked about whose company is this, and you created this contrived set of shares to maintain control. You're paying the price for it now. Your dividend policy reflects that need for control. About 4 or 5 years ago, during, I think, one of the French elections, I forget her name, Ms. Royale was her name, I think. She was running the election, and she suggested that all French companies be required to reinvest their money back into the company. There have been other countries where actually you've had mandated dividend payouts, where every company in the country has to pay out a fixed percentage of earnings as dividends. So let's take that second example. We'll come back to the French example next. Let's say I mandate today that all U.S. companies starting tomorrow have to pay, let's pick a number. What is the median payout ratio across companies that pay a dividend, like 30%? Let's make it 30%. I don't want to be extremely stringent. 30%, every company has to pay out 30% of its earnings as dividends or more. Bludgeon, right? Let's think about what kinds of companies are going to be hurt by this policy. Do you think large mature companies are going to be okay with this? Yeah, they're fine because a 30% dividend, they can afford to pay it out. So if you're ExxonMobil, you're saying, oh, that's not a problem. You think money losing companies are going to be affected by this? You're money losing, what do you get? 30% of, you can't collect dividends from your investors, but you have no dividends. You know the companies that are going to be hurt the most? If you're a young growth company making money, what am I requiring you to do? Pay out 30% of the net income as dividends. You're saying, what's wrong? You're making money. What's wrong with that? You're making money, but your cash flows are big negative numbers. It'll kill young growth companies. And you know what? That's why mature companies push for these mandated dividend payouts. They shed crocodile tears about how terrible this is that the government imposes all these rules, but secretly they're all incredibly happy about these rules because they actually serve the purposes of established larger companies, because it means the upstarts can't come up. So when you see these rules that are designed to affect all companies, there are some companies that actually benefit from these rules because it means the rest of the market is disadvantaged. So we've looked at Disney, we've looked at Vale, let's move on. About 20-something years ago, I used to do a session for BP in London where they'd fly me out to London and they'd fly 10 of BP's top engineers, petroleum engineers, into London. And my mission was to teach them all the corporate finance they needed to know in 2 days. It actually wasn't difficult. These guys were incredibly smart. They had the numbers thing down. So you could get it. But what I used to do as part of that session was I used to take BP through the entire corporate finance process. So I'd look at capital. So like Disney, I would take BP all the way through, and because they understood the company. So the first time I did this, I took BP's dividend policy apart. I looked at their free cash flow equity, and I thought I'd screwed up, because here's what the numbers look like. BP had free cash flow equity of 571 million between 83 and 92. It's not bad, right? So if you have 571 million in free cash flow equity, you can return roughly 571 million. They actually returned $1.5 billion every year on average. How do you do that? I mean, every year you're paying out $1 billion more in dividends than you bring. I mean, this is a problem, right? By the time you get to 92, in fact, you know how BP made up for that deficit? In 1 year they did an IPO, 1987, one of the most infamous IPOs of all time. Because in those days, IPOs used to be priced about 2 weeks before the offering date, because bankers said, what can happen in 2 weeks? And this IPO is actually priced on October 12th of 1987. And of course, October 19th happens, the stock price drops 22%. And one of the most pathetic shows of lack of backbone, here's what the investment bankers did. They went to the British government, which was the lead owner in BP, and they begged to be let out of the guarantee. They said, we really didn't mean it for something this big. Can you imagine if the analogy would be if you insured your house and the house burns down, the insurance agent comes and takes a look and says, this was a really big fire, wasn't it? You say, yes. So we really don't cover fires this big. A small fire in the kitchen we'd have covered, but the whole house seems to have burned down. Hey, that's why I buy insurance, in case the whole house burns down, not if my little desk burns up. And the British government, to give it credit, said, hey, you guaranteed it, you deliver. Every other year they went out and borrowed $1 billion to make up the difference. Not to take good projects, not to do exploration, but to pay dividends. And by 1992, they were the most highly levered oil company in the world. I mean, this is not an invisible problem. Everybody at BP knew they had a dividend problem. Even the janitor. You know how? Because when he asked for a broom, they said, no, we have no cash to buy brooms. It has to go for dividends. Every person, every layer of the company knew there was a dividend problem. But nobody did anything about it. Kind of a mystery. So let's go back to 1987, midway through this crisis, to see why nobody did anything about it. So let's call a top executive meeting at BP to talk about a dividend problem. So I'm the CEO and I say, you know what? Oh boy, we have a dividend problem. At that time it was all lords, so and so, you know. So it's all this British royalty around the table. And everybody says, aye, 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 aye. Everybody agrees we have a dividend problem. So we should cut dividends. Aye, aye, aye. Tremendous idea. But then nothing happens. To see why, I'll tell you one of my favorite fairy tales of all time. It's about these mice that live in an abandoned house. And they're being terrorized by a cat. So they decide to call a mice meeting. I don't know what a mice meeting looks like, but it's probably pretty chaotic. So one of the mice says, we have to get rid of the cat. Aye, aye, aye. Everybody agrees. And then one of the mice comes up with this absolutely brilliant idea. He says, let's put a bell on the cat. Brilliant, because then we'll know when the cat's around, we can escape. Everything. Aye, aye, brilliant idea, until one of the more practical mice asks the key question, which is, who the heck is going to put the bell on the cat? Not me, not me, not me. Now let's go back to the BP meeting. Let's cut dividends. Who's going to tell the stockholders? Not me, not me, not me, around the table. You're saying, what's wrong with telling the stockholders? They can see you're in trouble. There's a saying in dividend policy, you get the stockholders you deserve. You pay no dividends, what do you get? You get people who like no dividends. You pay small dividends, you get people who like small dividends. You pay immense dividends, you know what you get? Every dividend addict in the world owns shares in your company. BP had accumulated the strangest, weirdest group of people ever called stockholders in a major company by the mid-80s. And these are the people you're going to tell that you're going to cut dividends to? There's no way you're making it out alive in that room. So let's close with what usually happens in a meeting like this. Somebody says, let's put it off. Maybe something good will happen. Which for an oil company is what? Maybe oil prices will go up. This is how the problem festered. In fact, in 92, there was a brief period of glory for BP when oil prices jumped after the Saddam Hussein wandered into Kuwait. You can see people dancing on the desks at BP. Dividend problem's gone away. 2 weeks later, it was back. Finally, BP cut dividends. Everybody agrees this is the right thing to do, right? That's what happened the day they cut dividends. Stock price collapsed. 6 weeks later, the price had recovered. But in those 6 weeks, what was happening? The strangest, weirdest group of people ever accumulated as stockholders in the company were leaving. A new group was coming in, but there was a lot of blood on the floor. The existing CEO lost his job, half the board lost their jobs, and they deserved to. Why? Because they did not deal with the problem earlier when they controlled the process. So we'll finish this on Monday and start on valuation. And my nagging will increase exponentially because we have only 10 days left before the project ends. Okay? So expect more emails, maybe 2 a day. used to drive a minivan with 4 kids and
Test, test, test. Test, test, test.
I just need to check the battery. Make sure you've got more than half. Test, test, test. Okay, great. You're good.
Perfect, thank you.
No problem.
And then this, is this always on?
Don't know. Let's see. Lighting, speech volume. It's probably always on. It would be controlled here.
What just happened? Oh, you changed it.
Yeah, oh, sorry.
No worries.
Projector, lighting.
I mean, it's fine as long as it's
Yeah.
not this one.
You want the, like, turn PC, yeah. And you want to send it? Okay, good.